obviously wealth tech firms are headed upward, right? That's the, no, thank you so much for all being here. We realized, and we did this on purpose, that we gave you no bathroom breaks and no coffee breaks, because if you left, it'd be very hard to come back. There's a mob scene outside. You should, but if you need to get up and go to the bathroom and come back, we won't be offended. Feel free to do so. Tell other people outside to come in at the same time. Really quickly, exciting topic, great panelists. You know, Singapore is very warm, right? Because it's on the equator. And the equator is really, you know, the center of the earth. You know, and Singapore is in such a unique position to lead wealth tech, to lead fintech into the future. I mean, it's a great country, great rule of law, tax incentives, and has become more and more of a wealth management center for not just Asia, but for the world. The second biggest inbound wealth hub in the world, fastest growing wealth region in the world. Really excited to be here. Really quick, 2 sentences each on what you do, what your firms do in the wealth tech space as an introduction. Go ahead, Varun.
I run digital for Singlife with Aviva. It's an insurance company which also owns Navigator and ADDX. And we have a CASA account equivalent which gives interest. And I run that business.
Oi-Yee.
Hi, I'm Oi-Yee. I'm the CEO of ADDX. ADDX is a private market securities exchange headquartered here in Singapore. We're running on blockchain technology, so we can, of course, spend some time on that as well.
Hi, I'm David. I'm the co-founder of GoTrade. We offer fractional share trading to retail investors.
Hi, I'm Deepak Khanna. I head wealth and trading for Revolut in Singapore. Revolut has been synonymous with payments, FX, remittance services, but of late we've been getting into wealth services where I come in. So things like commodity trading, we went live with earlier this year, DPT, which we went live with earlier about a month back, and stock trading, which is coming soon in Singapore.
Cool. So, you know, this panel is about sustainable scale. Tons of money has flown into wealth tech. We've seen actually some firms rise up and fall very quickly. There seems to be many different approaches to serving the wealth tech industry. What do you think the market is oversaturated? I mean, I go on the street and I see not just Endowus ads, but a lot of different ads pushing different, you know, ideas or products, telling me to buy different things. So, do you think it's oversaturated?
See, all non-bank wealth platforms combined in Singapore are less than $40 billion AUM in a market which is $2 trillion AUM. Overall, globally, if you look at the $2 trillion of wealth which sits in Singapore from other countries as well. If you're looking at $40 billion as a percentage of 2 billion, there is a massive scale left. And we haven't even looked at where working capital management solution, treasury solution starts to come in. It's just scratching the surface yet. Of course, there are segments where probably there is saturation because everybody is trying to target the 18 or 20 to 40 segment, which has a decent income and is able to digitally self-serve. There is probably, I would say, a higher level of saturation in that segment. But overall, from a market opportunity perspective, it's too early.
Too early. Okay. I mean, we are early in that evolution. Does anyone else want to comment on that? Oversaturation. Go ahead.
Well, I'll just make an observation here, right? Many of us, actually even around this 5 of us, come from traditional banks, right? There's one piece that is, why are traditional bankers leaving banking to start up wealth tech or fintechs? It really, a lot of that is the frustration with the existing incumbent infrastructure, which has become too expensive to maintain well and to catch up with times. And there's a lot of regulation that have changed, and the tech and the ops are actually not coping with that. So many of traditional bankers are coming out and saying, how do I solve this problem? That's one piece of it. So it's an efficiency problem. But second is also the way the markets are shifting. There are actually a lot of opportunities to capture space that hasn't been captured. I mean, for example, private markets. You heard from Edmund earlier from Apollo, which is, it's currently zero exposure to retail and high net worth, or pretty much a very, very low percentage. So there's sort of two big opportunity sets that's creating a lot of startups. I think the question is whether it's saturated. I think there's some ways to go.
Okay, I'm going to skip the script here and jump to Deepak because it's sort of a segue to what Oi-Yee was saying. Despite the stiff competition from neobanks, Revolut has positioned itself as a market leader, offering a wide range of services. So how can WealthTech scale while remaining nimble enough to adapt in today's rapidly evolving market? Does every WealthTech need to tackle multiple verticals? I mean, should we specialize? Should we go broad? Revolut obviously has a whole host of services, different services all around the world. What is the strategy?
Yeah, so if I were to talk about the Revolut strategy, it's about being a financial super app. So we want to do all things money for customers, and we have a very wide range of customers that we are interested in. We believe that a customer should not be having 5 or 7 different apps, one for, let's say, payment, one for FX, one for stock trading, etc. So it's all in one place from a customer perspective. So we build those products that I just spoke about over the years. But we're also catering to different client segments. So we got beginners, we got experienced customers, we got individuals, we got business clients as well. We're also getting into services which are not traditional financials, like donations. So things that you don't associate with investment, etc. But if you believe in a cause and you want to donate money for somebody, you could use a Revolut app for that. You could also manage your children's financial services through an under 18 account as well. Now we're branching out into the wealth and trading services. So our strategy is about having multiple products rather than being a niche silo single product owner. And that's worked well for us. From a very small business about 7 years back, now we're talking to about 20 million customers globally. We got 800,000 customers on the business side, and that's sort of working for us. How we do it, I think we just want to keep things 10x better. So whenever we get something into the market, we want to say that it is 10x more simpler, 10x more useful for a client, 10x more rewarding, and that's what we feel that adoptability and attraction is quite high. I think just on the first question that you asked, I feel that the market is not saturated. There's a long way to go. Market share is one of the aspects to look at it. But I think there's also a segment of client which is likely to come on the platform, like I just spoke about, which is multi-product, which are underserved clients. And I'm not saying underbanked, but underserved, which means that you did not have access to advisory or stock trading because the amount of money required to start the service is very high. The fees were very high or were not transparent, or you didn't have the trust factor. So those are the things that come in if you're a multi-product rather than a single product silo. That's what we feel.
Okay. David, I'm sure GoTrade probably has a slightly different strategy here. I mean, you guys have gone super broad, a lot of countries, tons of users, and you can quote some of those numbers if you like to give people a sense of that at scale. What is the strategy there?
Yeah, so for us it was very much around financial inclusion. So very much the point you were making earlier is there are a number of people. We believe the total addressable market is probably about 270 million people. And so what we want to do is we wanted to occupy a space which allowed investors to come onto a platform for the very first time. So the proposition that we offer is you can trade from as little as $1. So the products that you're interacting with on a daily basis, like Apple, like Microsoft, and obviously Tesla, and all these other names that you encounter all the time, you now can gain access and ownership of those particular names from as little as $10. And I think that's, or even $1, I beg your pardon. So that has really resonated with people. It's given them a real true on-ramp into capital markets for the very first time. And so our focus is very much going into markets and looking into markets where that accessibility is not available today. It is a very, very high barrier to entry, and so we want to occupy that space. So to the point that Oi-Yee was making, born out of frustration is why you end up looking at some of these different solutions. And so one of our co-founders was trying to access the US markets and couldn't, and therefore we decided to go out and build this thing ourselves. So luckily fractional was coming live at the time, and so we were able to be able to bring that to a wide range of people. So yeah, the numbers are pretty phenomenal, and it really speaks to how much of a need there really was.
Okay, and then a question from our viewers actually, which follows up very well on what you guys were just saying. The benefits of being a super app for wealth and finance over offering a single specialized offering. I mean, I think we've all of us have approached this differently in our firms. Endowus very focused on being fee-only, digital-first wealth manager. localizing CPF, SRS, and cash savings. Singlife, Aviva, huge existing business, digitizing, et cetera. Super app focused on trading, tokenization of alts and private markets. So what do you guys think? Do you think specialization?
Not trying to time the market is what we would say.
Yeah.
So, for example, we own 2 brokerage firms which actually sell other insurance products also, not just our products. So if there is other product which is better for you, we will sell that, and it's fine. So what our view is that we can never have the best product shelf for everything possible. No matter what we do, we can never be the best for everything. And that's something which we've acknowledged. And which is why we enable those parts of our business. So we believe that there are parts of things for which customer would want an advice, but there are things they would not want an advice. For example, for your travel insurance, you would not want an advice. For a gadget insurance, you would not want to sit with somebody to discuss. Mm-hmm. But when you're planning something which is a 55-year, 70-year commitment for your family about protecting them for their old age and everything, you probably would want an engagement. You may want to do it digitally on a tablet per se, but you may not want to do it alone, on your own. So what we believe that for every individual, there will be a spectrum of needs of a customer. Some will be DIY, some will be with, I would say, assisted mode, some would be advisor-led. And we have enabled all of them to let the customer decide from that perspective, because the customer preference, COVID happened, nobody could predict. Mm-hmm. COVID significantly impacted the customer's preferences. A lot of customers who would not do a digital KYC on their own before would now do it. A number of customers who would do SingPass KYC before COVID and now. Number of customers who would do Pay Now top-up before COVID and now. It's drastically changed.
Yeah, I barely knew what a QR code was in 2018. So
premise is, if we cannot have a crystal gaze for 15, 20 years down the line of what all COVID 2, COVID 3 or similar things could happen, there is we would not want to time them. We would not want to time it. We would want to position it that yes, we have all of these, and if, for example, it moves a lot more DIY, we're there. But if some products become more complex, because now customers want to live longer, they're living longer, so their definition of retirement and critical illness solutions have changed. So if that moves a lot more towards human, we have a solution for that. So what we would look at is, we would want to be the best shelf possible in whichever mode you would want to consume. And we believe as gig economy moves, so like your traditional retirement, CPF is no more relevant. So that will change. We cannot time exactly which way it will change. Mm-hmm. Will it move towards Nordic, where there are government pension and private pension? Or will it be a lot more American, where it's like people do it only and the government will totally step out of it? Or there will be a new Asian model? We don't know. We will position the platform to be able to handle the way it changes. Mm-hmm. So we would not pick, we have probably a third approach. Not try to do everything the best, not try to be a financial super app. Right. You know what you're best at, and you know what all stuff you need to enable, and then drive along as the market evolves.
It's an interesting perspective because you guys, you have a very large incumbent business, whereas a lot of us, are building a business from a zero, basically. So, Oi-Yee, what's your view on this in terms of, being attractive by specializing or broadening?
Yeah, I think that's a very interesting question. The way that sort of I think about our business, it's actually a combination of competencies we've had to build, right? It's about the technological capability combined with the legal and regulatory aspects. And of course, the commercial innovation has to come alongside that. And I think about, we specialize in alternatives partly because we think our technology can solve a lot of the issuing and post-trade pains that financial institutions and individuals have faced along the whole alternatives universe. But even within that universe, it's actually quite wide, right? From credit to funds and things like that. I think it will be a function of focusing on our strengths, where that might lie, and building the partnerships and the relationships that go with that to create that scale. And I don't think anyone really has the perfect answer. I think some people will do well, very specialized. Maybe the tech is not is particularly focused on, for example, credit, or a business in particular has a strength in high net worth individuals. So I think it kind of depends on the company itself and the strengths and the competencies it's building upon.
Okay.
Yeah, and if I could just add to that, I think it also depends on what problems you're trying to solve, right? So I think you've got to start somewhere. Not all firms are massively capitalized that they can go out and do all these things. And so you've got to start somewhere, and you start off by what problems are you trying to solve, and then from there you build a business from that. And so I think everyone's journey probably looks a little similar to that. There might be aspirations for a much bigger business later on, but frankly, you've got to start somewhere. And I think if you start with that notion of what problem am I solving and occupy that space and do it really well, you have a foundation on which to build a bigger business, if that is in fact your desire.
I think being broad doesn't mean you're not specialized. Yes, you may not be the best player in the market across every feature of that product. And definitely, we probably will not be able to compete, whether it is some of the pricing, some of the incentives sort of being sent in the market right now. But I feel that given the fact that you're talking about wealth here, which is a highly regulated market, you need to have those protections, those specializations, which are the minimum standards. But of course, be meaningful to a client. My sense is that Revolut built about 20 million customers right now, which some of the traditional players took like 40, 50, 70, 100 years. And that's because the definition of brand and trust is changing. And that's where probably specialization can be attuned to. It is no longer about how big your balance sheet is or what your pedigree is. It is about whether the product works. Does my app work? If I want to call somebody, or if I want to chat with somebody, I want resolution to my problem, do I get an instant response, or I have to wait 4 days before I can do something? So as long as the product is working for a client in terms of the feature, which is more meaningful to the broad base we're talking about, I think that's what you're looking at. And to me, that's specialization. But yeah, I'm not talking about every aspect. Of course, we can't compete on that. But you're not diluting specialization just because you're more broad-based.
Okay, interesting. So just painting a picture of the future here. Let's say 10 years from now, do you expect people to use multiple digital financial services, or to sort of centralize that in some way? I mean, it could be the case that the super app also partners with other players to centralize everything. I know we talked about the digital banks perhaps taking on such a strategy as they enter Singapore. We're seeing it happen with virtual banks all around the world. Do you see people wanting to consolidate or wanting to spread out? I mean, from what I've seen in the past is people typically, well, depending on the segment of the market, would have multiple bank accounts. And I mean, it's inconvenient to have multiple bank accounts, but they do it because there's a perception or maybe a reality that it is safer. Where are we headed in this digital experience?
Historically, the market has always moved from the great bundling and unbundling.
Correct. And then
first generation,
keeps on going in and out.
You had the MSN portal and Yahoo portal generation. Then it all went away. Then then everybody wanted to specialize. And now it's like kind of coming back, where Facebook is saying, okay, I will have like a consolidated identity across my platforms, and I will try to unify them, while the people who are branching out. So let's say a Snap or a TikTok would say we want to have one thing only. So that bundling goes on. But in financial services, I would believe regulations will play a lot more important role. In Europe, for example, where open banking and mandatory API access is there, so you are regulatory required data to open it in a much more structured way, you would see a lot more aggregation happen, because a new challenger could build something to be able to build on top of others.
Yep.
However, when you look at, let's say, Asia or US, the open banking, most cases there are no laws. And even if there are, they're not the European level. So in Singapore, you can't build an aggregated app per se. Non-FIs are not even allowed to enter SG Findex yet. And SG Findex also gives you like data once a month.
Correct. Yeah.
And each FI you want to onboard, you have to add them one by one. So it's not like one click you pull all. So that's very different from, let's say, Europe. So I believe at least in Asia and US, you would still have multiple players. However, in Europe, you may have a scenario where people have one, where the manufacturer and providers may be separate, but interface access becomes unified. But in Asia, the interface access will remain separate.
Do you think regulation will play a big role?
I would say that regulation will be the deciding factor in this from that perspective, because does your access interface become standardized or not? That's something which is beyond market forces.
Yeah.
And because Europe has taken a position that they will mandatorily regulate it, while US and Asia have taken a position that they would not mandatorily regulate it. So you have two diametric poles already. So that means regulations define it.
Okay. Oi, what do you think? Do you think people will have specialized alternatives, digital, other things?
I think people will still want choice. And if you think about bank accounts, it's likely that whether it's on the investing side, we'll likely have more than one. The question is more than one what? Is it an app, or are you still talking about a traditional advisory relationship with the bank? So I suspect it's going to become a discussion around what is the mix between that two, rather than have a consolidation of investing apps to a single source. I think alts presents a very interesting solution, partly because it's a growing space, but I think it will start to converge between traditional public equities and bonds and alternatives at some point, whether that's in a place of a super app or in a place of an aggregated, platform. I think that remains to be seen. I think the bigger question is more what's the mix between what we call offline and online, and I think that dynamic will continue to shift. Consumers who want to hear a friendly voice over the phone, or it wants to compete on prices, can always then go back to the advisor and say, it's cheaper this side. So that's a dynamic I think we should be watching out for.
Okay. Any other comments? We can.
Yeah.
Go. Okay. I'll just give an example. So my daughter's playing games. She's done well in one particular game, reached level 7, got some assets she's acquired there. She goes to the next game, she has to start from level 0. So whatever she has built in terms of her value there has got no significance on the second app. So I think the portability between apps is very important. You take the financial industry, if I want to buy a US stock, I have to have an account in one app or one bank. I have to then move money for which I'm using some other player, a second app. I have to do FX because the US trading person is not doing FX. I have to do a third app for that. And then finally, I do a US stock trading fourth app. The time I'm spending between these 4 transactions, between 4 apps, and the cost I'm spending is humongous. So if somebody could consolidate that for me to instantly purchase a US stock when I want to do it, of course, the pricing will not be as good as single app, but over the 4 apps that you're using, the time and cost you're spending, the value that's coming to the client is far more. So of course, there will be choice, don't deny that. But in terms of convenience factor, the more you're portable across different apps and consolidating into a single app probably has more value compared to having 4 or 5 different apps at any point in time.
Yeah, that's exactly the point I was going to make around a frictionless experience. So to the extent that people are looking, you want to meet your customers where they are. So we, for example, have started with one product. We've solved some of those problems, fortunately, already in terms of trying to move the money around, born out of a very frustration that you talk about. And so there are a few things that we've kind of done at least to try and mitigate some of those frustrations. But I think as we look at how our customers grow, and I was saying just before we came onto the stage, about 18% of our customers have never traded before. So we have a US-only product, but 18% of them have never traded. Not never traded US, just never traded at all. And so that's kind of their starting journey. And so we got to work with those guys to see where are they going to go, what's their evolution, and how can we meet those needs from an ongoing perspective. The other one is obviously consolidation. And so we see this across the industry all the time, that the easiest way is either build or buy. And so what often people do is they'll go make an acquisition to plug a gap that they don't perhaps have today, or they have today, I beg your pardon. So I think there's some of those shifting sands that are always happening. But I mean, obviously in 10 years' time, it's going to be hard to say. But I think that's kind of where we've always moved, is that aggregation and consolidation within the space as people are making acquisitions to plug gaps that they have. And then also the customers growing up and becoming more sophisticated and looking for those solutions. So whether they find them with you or someone else, I think that choice element is still going to be there.
Okay. There's tons of data. We've talked about big numbers, $2 trillion, fastest growing country in Asia for inbound wealth and things like that. But honestly, a very small amount of AUM that has gone digital. What is stopping people? What is stopping the market from moving?
So I usually have an empirical test that if the weekly drawdown on your portfolio is more than 2x your monthly income, weekly drawdown on your portfolio is 2x of your monthly income.
Okay.
That time you need somebody to hold your hand to
I
tell
see.
you it's going to be okay.
I see.
And so premise is as people's wealth starts to grow, even a 3% drawdown in a week starts to be 2x of their, because the wealth compounds faster than their personal income growth from that perspective. So when people start to hit that, and in Singapore, the moment your AUM is somewhere between 250 to 500K, that time a weekly drawdown can start to go 2x of your monthly salary in terms of weekly, and that is an empirical point at which you need a human, because that time an email message from the CIO of the digital platform does not calm you down.
You must not be a very good investor, Varun. if you get so nervous so easily.
No, so the premise is, for an average person on the street, the premise is, has your need become complex, or the volatility has become too much because you stop seeing it as in percentages.
Yeah.
You start to see it in absolutes.
Yes.
Which is why I said the exact drawdown is 2x of your monthly income, that the dollar amount starts to make you nervous.
Okay.
So that's when a human touch becomes more valuable.
Okay, so you think this is one of the inhibitors of more wealth digitizing at a faster rate?
I would say that's one part, and what that becomes is a trigger when the digital platforms acknowledge that there is a part which will be in a DIY, and there will be part which will be human managed, and there will be a hybrid beyond a point. So the number of customers who will be, let's say, $3 million AUM and pure digital would be very less, versus they having 2.5 million being managed where a human is involved, and about 300-400 they're doing on their own kind of thing.
Okay.
So some kind of that balance, if digital platform starts to look at that, people would not want either or. They would want a mix of both. That, I believe, would start to open up market further.
It's a good thing Endowus is a mix of both, so that's great. Sorry. Oi-Yee, what do you think?
I think Asia, I mean, if I just, somebody compared this for me, not a quote from myself per se, but Asia has a few dynamics that are sort of makes it a very young investing population. So first of all, I think Asians tend to be, they tend to be traders, right? They like the stock market, well, until maybe sort of this year. But they kind of like to play single stocks, they hear from friends, they kind of do this, do that. So that there's a bit of that wealth planning, wealth thinking is not as well developed as it is in the West. So I think a lot of it is going to be about education. A lot of it is going to be understanding what tools are available to them to look across asset classes and build their own portfolio that sort of meets their own life cycles. The second thing is sort of there's also, a very big private banking or space where there's still reliance on advice as well. But the more that digital platforms, I think, present education opportunities and help the younger generation who are generally more digitally savvy and generally would sort of read up and do it on their own, I think the more that you will see digital adoption taking up in more rapid style.
Okay. Interesting. Anything to add? No? Good?
I think for me it's adoption curve, right? So cars did not go driverless overnight. There was cruise control, there was power steering, there is gearless cars, and of course now we're still getting there. Banking, financial services will not go driverless immediately. It's going to take some time. I'm liking the word hybrid, which means the tilt is 50-50. Just about 2 or 3 years back, I believe, I could be wrong, but I believe the percentage of online stock trades in Singapore overtook the manned trades only about 3-4 years back. Okay. So trades were still happening through phones, through remisers, through wealth managers, broadly speaking. And when online took it over about 3-4 years back, I'm happy that advisory sort of had a hybrid level. I'm hoping that the percentage is going to tilt more and more toward the digital side because there is a clear advantage of digital to take out bias. One of the main problems with humans is that we're not rational. We have that emotional curve, and we end up buying things when they're rising. We end up selling things because of fear when they're falling. We should be doing the opposite. Robo-advisory is a classic example which resets that. So as an asset class outgrows because of outperformance, you sell it, and you buy something which is underperforming on a relative terms, and therefore you're rebalancing the bias that you may have. And those are the things and differentiation which need to come in to really bring the adoption ahead. Right now, I feel the differentiation in the industry is largely around cost. Or some interesting platform, easy to use. But once all these other USPs will start to come in, I think that's where the adoption curve will continue to grow. But again, we are at a very early stage, at least in Singapore, Asia. We are at a very early stage right now, and there is a long way to go.
Okay, wonderful. Thank you, everyone. That's all we have time for. Very insightful. Yeah, moving on to the next panel.
Thank you.
Thank you.